Let's take it to the floor show. And JP Morgan Asset Management, multi-asset solutions global strategist, David Lebovitz. David, misfiring a little bit, or are you still very much focused on risk on? And by the way, we should mention that Palantir, as Charles brought it up, is about to report. So we may get more sort of inside granularity about AI.
So we are still pro-risk in portfolios, but we also recognize that where valuations are today, right, adding risk at these levels can feel a little bit uncomfortable and be a little bit challenging. And so for us, we've really taken a step back and said, look, 2026 is going to be a very good year from a fundamental perspective. We're looking at above trend economic growth in the first half and likely into the second half as well. You should see inflation continue to decelerate. We do think that there's room for the Fed to ease up to 2 times in 2026. So you put that all together and you have a very supportive fundamental environment. Again, the rub in the current environment is valuation. And so we'd be buyers of any dips, but adding risk at these levels can be a little bit challenging.
Yeah, you don't want to buy at the highs, or certainly, I'm not talking about Oracle, because Oracle is certainly not at its highs, but some of these names have continued to charge upward, especially now it's memory chips.
Yep.
You want to be careful is what you're saying. You are pro-risk, but cautious.
You want to be careful, but I will say that all-time highs tend to cluster together, right? When markets get momentum, they can oftentimes set high after high after high. And so, you know, for us, the most prudent strategy is to make sure we're fully invested more than anything, but have a little bit of dry powder on the side that we can deploy if the market does pull back and give us that opportunity.
I will tell you, people who got nervous January 2nd saying, how can we possibly have yet another year of really strong numbers for the markets? They missed out. I mean, the Dow Jones Industrials just closed out its 9th month in a row of gains. S&P, 8 out of 9 months have been wins. NASDAQ, 8 out of 10 months have been wins. And the Russell, 8 out of 9. So this is still a momentum play at the moment. You don't want to get caught underneath the hooves of the bulls.
I would agree with that, but I would also highlight that all of those sequential gains for the different markets that you just mentioned have been underpinned by profits. And that's part of what gives us confidence this year, is that the earnings growth does look like it's going to be there. And furthermore, I would argue that the earnings growth that we've seen, which has very much been concentrated in the Mag 7 stocks and the mega cap tech names, does look like it's beginning to broaden out. That's why I think you're seeing the Russell 2000 perform a bit better. When we look outside of the U.S., right, international markets, particularly EM, are performing a little bit better. And so the global picture, when you put it all together, is one of increasing synchronization in economic activity, inflation, which is in the rear view, and markets are not concerned with inflation the way that they were a couple years back, and central banks that, again, are either on hold or look set to do a bit more easing. And so in this environment, we like equities in particular, because when we look at the riskier parts of the credit spectrum, it's not clear to us how much spreads can tighten. We want that upside via the price, and that's what keeps us in equities.
And we had some big names last week, 4 of the Mag 7 reporting. This week, we've got more of them. Alphabet is reporting. It's a very crowded calendar this week coming up, and we just want our viewers to always be ready for these names. Again, after the bell, NXP Semi, Teradyne, Palantir. We already got Disney this morning. Tuesday, we got a lot of the pharmas, Merck, Amgen, Pfizer, Clorox is in there. Wednesday, our parent company, Fox, Uber. Big names here, Yum, GSK. Thursday, there you go, Amazon, Hershey's, Affirm, and then Friday, Toyota, Under Armour, Centene. Would you be broadening into any of those different sectors?
So we still do like technology and communication services. We're starting to look more at things like healthcare. Healthcare looks pretty beaten up, and we think that there may be a valuation opportunity.
Can I just say about
there.
Communications?
Please.
How about AT&T and Verizon? They came out with very strong earnings, and they have good dividends. So is that part of your play here? So
we do like leaning into income, because one of the things that we've realized is, you know, a lot of these equity trades are correlated, right? They all tend to move in the same direction. And so when big tech doesn't work, the market sells off. It kind of pulls everything down with it. If you have that stream of income, that inherently helps buffer against volatility. And I think that's really what's so key to us over these next couple of weeks as we wrap up the earnings season, is understanding what these companies are seeing in terms of demand, getting a sense of what the prospects look like for 2026, and back to the technology story, understanding what the capital spending plans look like this year. Because as we saw the other day, we're seeing companies, again, start to look more to debt markets, but also equity markets. And so putting shape around that whole trade is particularly important when we think about navigating this year.
In your title, it says multi-assets.
Yes.
So I've got to bring up gold and silver. Yeah. Incredible one-year runs for both of them. However, Friday, $7 trillion evaporated off of the price of what we've seen with gold and silver. Today, we do have gold still down about 26 bucks, 4,687. Silver barely higher at the moment to $78. It was well above 100 bucks. Is this a speculator's moment that you would just stay away from?
So when we think about real assets and things like commodities, we tend to take more of a through the cycle view. I mean, I can't tell you what gold is going to do over the next week or over the next month, because at the end of the day, the price is only what somebody will pay me for it. But when we think about the direction of travel for the global economy, we do see these rising forces of economic nationalism, fiscal activism, so governments more focused on their own backyards, deploying more capital, which is something we didn't see in the post-GFC environment. And as we observed in 2022, when governments spend a lot of money, that can cause inflation, or at a minimum, inflation volatility to begin to pick up. And so that's where we see value in holding those assets. I will say, I think the price action on Friday, you had a lot of people on one side of the boat expecting a different choice for Fed chair than where we ended up, and also expecting that there was a bit of debasement that may occur if we had a Fed chair that was overly easy. But with the decision that was made on Friday, I think that puts us firmly back in a camp where the Fed is going to be governed by committee, and they're not going to do anything too far to the right or too far to the left.
You know what? We've got two former Fed heads coming up to talk about the president's pick of Kevin Warsh, and some are wondering, we'll show you the bond market too, but most of the yields across the entire curve are moving higher. So it is a fast and furious market, folks. I do just want to say that right now the S&P is up 47 points. So that is well above the 39 rather, that it needs to mark a record at the close. But it's all over the map. David, great to see you.
Nice to see you too.
Thank you for joining our Atlas here at Fox Business. We appreciate it.